Let's now do a quick detour and go across to Harish Krishnan, Co-CIO and Head Equity of Aditya Birla Sun Life Mutual Fund, joining us on Talking Point. Hi Harish, good morning. Thank you very much for joining us. Let's start with the broader markets and get some perspective going from you on that. Markets have been fairly volatile despite us in kissing distance of record highs. What is your outlook? August has seen fears from a US recession to geopolitical stress, Federal Reserve rate cuts, yen carry trade issues, corporate earnings fluctuations. How do you view the current situation?
Morning. So clearly, we do acknowledge the fact that corporate earnings, from a broader perspective of over the course of the last 3 years, have kind of moved up meaningfully as far as India is concerned. We also acknowledge the fact that there has been a significant amount of liquidity that's been chasing Indian equities. Having said that, and the fact that the corporate health of India Inc. is in the best of shape, I think that we're taking cognizance of the fact that valuations are quite heady. There has been a significant expansion of multiples, especially as we go down the curve. So when we look at, say, from pre-COVID levels till now, over the course of the last 3.5, 4 years, and we see how much of the market cap expansion in various blocks of market cap, be it large cap, the top 100 names, 101 to 250, which is the mid cap, small cap, and micro caps. What we see is that broadly, as far as large caps is concerned, the top 100 names, almost the entire market cap delta can be explained by just earnings. In fact, earnings have gone up even more than what the market caps have gone up in aggregate. So there's been some amount of derating out there. But when we look at mid caps, it's been roughly about 66% of the market cap delta has come through by earnings. The balance has come in by valuation expansion. When it comes to small caps, it's at 50-50. And when it comes to micro caps, which is 501 and below, almost valuations account for 67% of the increase in market cap expansion. So therefore, we do think that it takes a lot more time to be a lot more measured at this point of time. Risk has got rewarded disproportionately over the course of the last 12-18 months, and one should be a lot more sanguine about the prospects of equities going ahead, even as one remains positive from a 3-5 year perspective.
And that makes it very tough, Harish, because, I mean, the general view is that this is a bull market which is rising only because of liquidity and the markets are running ahead of themselves. I mean, gold is now available at the price of diamonds. And, of course, investors, given that context, still need to be careful. This is a tightrope to walk, right? What do you recommend investors, new investors? Let's start with new investors, because they've never seen a down market, and they also may not know the importance of disciplined investing. What do you feel new investors who've got incremental money on the sidelines should be doing? Is it best to sit on some cash and wait for an better opportunity? Or would you say that go out and do your SIP, because that's probably the only way to build a significant corpus, and timing the market is a futile exercise, we'd all agree.
That's right. So clearly, I think we can all agree that time in the market is far more important than timing the market. So you bang on in that context. What we do recommend is to have an asset allocation perspective. For now, of course, it may appear that equities, and especially lower down the curve, be it SMEs or small caps and micro caps, can hold a lot of sway and promise. But I think 3-5 years or 10 years down the line, possibly it may not be as optimistic as what things are being made out over the course of the last 2-3 years. So don't extrapolate the last 2-3-4 years cycle into the future. Third, that we do advise is that whatever be your risk appetite, and it's of course personal to each and every individual, but if you are primarily in small caps, go down one risk notch lower. So if you were in small cap, be it in mid caps, if you were primarily allocating to mid caps as a risk profile, move into large and mid caps. If you were into large and mid caps, move into flexi cap. So move down at least one notch so that you're not completely out of equities, because clearly the medium and the long term story as far as Indian equities is concerned is still very encouraging. The balance sheets of corporate India is still very good. The banking system is in good shape. The macros are in good shape. So don't miss out by saying in cash and waiting for that inevitable crash to come through. But go down one level of risk curve and follow a prudence of asset allocation at this point of time, rather than going fully into SMEs and small caps and micro caps at this point of time.
In fact, why don't you share with me a view on the SME space with the recent high-profile IPOs that have been debuting on the street? I mean, every day a listing comes in with a gap of 50 to 60%, and that's phenomenal, right? But what are your thoughts on the SME space?
I mean, to be quite honest, it's not a space that we professional investors actually participate in. So we are as much as a ringside watchers of the phenomenon that you are describing. But we did this analysis. Roughly, the markets can move in a random walk, as they say, on a daily basis. It can go up, it can go down. But there are equal probability of going up or down on a daily basis. What we've seen in the last 15, 18 months when it comes to SMEs is that markets are going up, or the index level, I'm not even talking about individual companies out there, index levels are moving up 70% of the days, which is a significantly higher amount of days that those indices, especially in the in the SME side, have started moving up. So again, these are great times for those investors, but one can't be basically predicating only on the fact that you're going to have more liquidity chasing these names, and you'll be able to find another buyer for your name. So at least it's purely as an observer that we are kind of making this observation. We don't evaluate any of these companies ourselves as professional investors.
Uh, Harish, everyone likes private banks, and so do you. You've got an Axis, an HDFC, and ICICI Bank on your portfolio. But unfortunately, the trade has still not come in the true sense for some of these private banks. What, in your opinion, is the biggest restrictive factor for private banks, and when do you see the gains or the fair, stock price movements on some of these private sector banks?
Right. So we were underweight the space about a year and a half back, primarily predicated on the fact that you had the best of everything going in for the banking system. You had very strong credit growth. You had NIMs, the net interest margins, which had expanded quite significantly, and you had very low credit cost. So much so that profit pools of just the scheduled commercial banking system had reached a 25-year high as a percentage of GDP at 1% of GDP. From then, as we look over the course of the last 18 odd months, where banks have underperformed quite meaningfully, we see each of these three pegs normalizing. So credit growth, which was growing quite strong due to regulatory nudges of wanting to align it with deposit growth, has kind of come off. Secondly, if we look at net interest margins, they have started coming off from the significant highs that they were there, and you have started seeing some amount of normalcy when it comes to credit growth. Now, at the face of it, all of these are negative developments from earnings perspective. So we do think that there is likely to be a softness in earnings, but the space has got derated significantly. What used to be some of the best run private sector banks, which were trading at anywhere between say 17, 18 times times price to earnings forward have come down to as low as say 12, 13 times. And to our mind, therefore, a lot of derating has happened because these profit pools were unsustainably high. And as the profit pools kind of normalize, is where we think that there is going to be a re-rating back into these spaces. So that's the approach that we have when it comes to the banking space. That the best of the times, ironically, are not the best of times for stock prices to move up, and the best of the times is now behind us. In fact, we are starting to see that profit growth is starting to trail off in many of the private sector bank franchises, which to our mind, ironically, is very good news, because we think that now profit pool levels are normalizing to more sustainable levels, which is what a multiple can be given on. So we view the fall in earnings or the slowdown in earnings as a welcome development, than looking at very high earnings and then wondering why is it that stock prices were not reflecting that kind of earnings growth. So that's broadly our view when it comes to the banking space in totality.
Right, Harish, let's start talking about the leadership sectors. And the leadership sector in this current bull market up until now has been hands down PSU. Across the board, from metals to defense, even insurance PSUs, everything in the PSU space has gone up like a rising tide phenomena. Some of that may be catching up in terms of defense PSUs at least, right, in the last couple of weeks. Do you feel like the leadership mantle will continue to be carried by PSU stocks over the next 2 to 3 years, or do you feel like it's now time to take profits off the table from PSU names across the board?
So I think it's a lot more nuanced out there. There are certain pockets where valuations have clearly gone up significantly. So from a fundamental perspective, if you look at it, there are certain pockets which are monopoly stocks, no doubt, where the near-term outlook is really good. But if they're trading at say 15, 17 times price to book, these are very, very heady valuations. Just to as a context, the infra cycle peaked at about 7, 8 times in 2007-8. So we are well past those levels when it comes to pockets like in defense. But on the other hand, if you look at say energy and utilities, or oil and gas or oil and marketing companies, their valuations are a lot more sanguine. We really haven't, while they have performed, no doubt, but we haven't seen those kind of parabolic moves in a lot of those spaces. So I think it is not to say that the trade is completely over and out, but yes, we do prefer the private sector franchises wherever we can over many in the public sector franchises. But I wouldn't say that the entire pack is primed for a massive kind of a correction. We do still think that there are pockets within the PSU space that are very attractive and which we continue to own in our various funds.
Right. Talking about a PSU fund that you also have under your umbrella, 85% gains. I mean, that's phenomenal. I know that a lot of fund managers that have missed out on the PSU rally because of underexposure. For those investors in that fund, what do you recommend they should do? Should they continue to go in and invest into that into the fund, or maybe take profits off the table? It's a very specific question, but it's about 5,000-6,000 crores of AUA that you handle.
That's right. So I think to all our investors, we are saying the same thing, which is to elongate your investment horizons. Don't extrapolate the past returns. The good thing about the PSU fund is that there is some amount of dividend flow through that comes through, which is quite still quite large compared to many other spaces which are there in the non-PSU space. But one should definitely be prepared for an underwhelming kind of an outlook when it comes to the next 6, 12, 18 months, and not extrapolate what the investors have seen over the course of the last 1, 2 years. So as long as people are prepared for that, I still think that this is a space that can give you decent returns over the course of the next 3, 5 years. But I mean, is it a place wherein you can put in massive lump sum at this point of time? Possibly not. One should be a lot more disciplined. Like I said, this is the time to take down risk rather than embrace risk head along across all our equity products.
I noticed Harish, when I look at your portfolio, you only own one IT stock, which is Infosys. Do you feel like, one reason that IT stocks corrected significantly was largely because legacy businesses, legacy clients were going to be threatened, or there was a AI threat in that sense? I also noticed that you don't have the broader market, large cap, mid tier 2 IT companies. What do you feel? Do you feel like for the next 2 to 3 years, maybe legacy businesses in the IT pack is probably the best space to be in? And is that why you own Infosys? Or do you feel like, there is a better valuation maybe around the corner for some of the broader market tier 2 IT companies? I can see the bias, but I want to understand why.
So firstly, I think we have some exposure in tech. We have an overweight stance on tech, in fact, in many of our schemes. So yes, we do have a larger preference to the larger tech-oriented names. As you said, the legacy names compared to mid-tier names, and mid-tier has clearly done quite well. So we do have some ownership there, but our preference is more to the larger names. Our view on this AI disruption is it's more an opportunity than a threat as far as Indian IT services is concerned. I think Indian IT services have seen an impact of twofold. First is from pre-COVID till now, we've basically seen a greater offshoring that has happened as far as Indian IT is concerned. Now, as more and more offshoring happens, the revenues do get deflated as a resource out in India can do a lot more than a resource based on site. Typically, higher offshoring would entail higher margins, and therefore it is a win-win for both the IT client as well as the IT service provider. Unfortunately for Indian IT, over the course of the last 2, 3 years, given the fact that they hadn't hired pretty much workforce before COVID, they saw a squeeze with the demand coming through, and therefore they saw a massive hiring that had happened in 21 and 22, which led to a squeeze in margins. So we've seen actually both revenues trailing off as well as margins kind of impacting. We do think that Indian IT companies will get their margin piece back into shape over the course of the next 2, 3 years. These are some very well-run companies who know how to pyramidize their workforce and to get the unit economics in place. And as and when the recessionary environment in the developed world, especially US, comes to pass, and we are on the other side of it, we do think that there is going to be a greater spend on Indian IT. So I think Indian IT is therefore a very good space to be in. Yes, when it comes to the allocation between large, mid, we have a greater preference to large cap, primarily because valuations are a lot more sanguine out there. But we do also own some very exciting mid and small cap names across many of our other funds.
Harish, another one that I want to talk to you about is the FMCG space and consumption. We saw in the first quarter was largely marked by top line growth, primarily driven by sustained recovery on the rural side of things. And of course, from the way we look at it as well, it seems like rural growth is outpacing urban areas, despite the heat waves, despite various concerns that rural India is going through. And I know that one of your main portfolios doesn't have any consumption names. I'm not sure, correct me if I'm wrong, but you have a consumption fund. Do you think it's time to increase exposure to consumption and in the consumption pack to rural growth as opposed to the urban areas?
Right. So I think, at this point of time, there are two specific thematic funds that we do advocate our investors to evaluate. One is the consumption-oriented fund, which we call the Gen Next Fund, which has been there for close to about 20 odd years, which has seen multiple cycles. Consumption is a reasonably evergreen story in India, given our young population, our increasing per capita incomes. Yes, it has hit some kind of an air pocket in the last 2, 3, 4 years. As the government has focused on supply side stimulation far more significantly compared to demand side boost. While that can continue for under 6 months or a year or 2 years as well, we do think that of the reasonable underperformance that the space has seen provides us a greater opportunity at this point of time. So we do think and do think that investors can benefit by participating in this kind of a thematic. The other theme that we are advocating, which has reasonable margin of safety, is the Digital India Fund, which has a larger weight on IT services as well as the Indian IT or the Indian tech landscape, which is seeing a lot of new listings, a lot of new startups coming through, multiple ecosystem developing out here as well. So I think these are the two spaces that we would be advocating at this point of time from our thematic basket, that we manage a whole range of themes which are there, which we think that investors should definitely evaluate.
Right. Very lastly, Harish, before I start wrapping this conversation up, will the Nifty be higher in December than it is now?
I mean, we're not astrologers, so I really don't know, and we don't really kind of
Right. What is
have
the
that.
ideal time horizon for fresh SIPs?
I'd say that the goal for investors need to be at least 5 years out. Ideally,
Say
you would want to.
investments, as in when you're doing a staggered investment, what is the ideal time horizon one should spread their investments over?
I would say at least over the course of the next 12, 18 months should be a reasonable time horizon for people to stagger their
So
investments
either
in.
you do it weekly or monthly, do it over the 12 to 18 months. How much percent of your portfolio do you recommend sitting on cash? If you're doing an SIP for 18 months, there will have to be some cash on the sidelines. Hence the question.
Sure. So I think, there are products which automatically invest in, say, tax efficient products, including arbitrage fund
चाहिए
or
इसके पास?
various fixed income instruments. So you need not necessarily be in cash at all. There are solutions provided by the mutual fund industry, including Aditya Birla Sun Life, which help you obviate that issue. But I would say that, it's not really a call on cash. It's more a call on anticipating volatility and turbulence ahead, so that you can benefit from that by staggering in your investments, rather than saying a call that you're wanting to time between cash and equity.
Very quickly, Harish, mid cap is expensive, small cap some argue is a bubble. Large cap is where there is safety or margin. But the fact is the participation hasn't come from large cap names. So would you still stick your neck out and say overweight large cap because your portfolio is overweight large cap?
We do think so. I mean, we think that there is a greater margin of safety. We don't see too much of a dispersion coming in from large, mid, and small. And even if you look at this calendar year till date, most of the funds that we are managing are in a reasonably tight range. So the point being that one is not going to see a disproportionate high return coming from micro cap, small cap, mid cap compared to our flexi cap or large cap, and therefore from a risk adjusted basis, we do think that it makes more sense to be tilted towards large caps.
Very lastly, Harish, top sector where you still see some value?
So we've got three sectors which are dark horses. I mean, over a 3-year period, I would say cement seems to be a very interesting juncture, which hasn't really played out over the course of the last 2-3 years. That could be one. Consumer durables is an area where we've stuck our neck out at the start of the year. We still think that there is significant steam out there. The last one I would say is metals, which is an area where today there is a lot of doom and gloom from China's perspective, but Indian companies have delevered their balance sheet significantly. So these are the three pockets which I would say, pretty much nobody is really talking about in our opinion, and which can therefore spring a surprise over the course of the next 3 years.
One sector that looks stretched right now to you, Harish, which is best to take profits off the table if you've made money in it?
I think defense would be that case.
I think most people would agree with you on that. Defense has had it rough in the last few days, and stocks like the darlings of D Street, like the Mazgaos and Garden Reach, have been selling up. But great chatting with you, Harish. Thanks a ton for joining us today on Talking Point.